most of you will not be able to figure out your debt to income ratio because if you're not using the right income calculation, then all of the numbers that you are crunching are completely irrelevant and very likely to be wrong. Good morning, good evening, or good afternoon. Today's video is about debt to income ratio or mortgage debt to income ratio. So by the end of this video, you're going to have a better understanding of what it is, how it's calculated, and why it's so crucial that not only you are super transparent with your loan officer, but also that you find the right loan officer. This is your one-stop shop for anything and everything mortgage education. I drop new videos every Tuesday and Saturday, so don't forget to subscribe and hit the bell to be notified. My name is Stephanie Weeks, and I've been a loan officer for 17 years, and I've helped thousands and thousands and thousands of customers with millions and millions and millions, maybe even billions by now, in mortgage financing. My goal and my mission is to help spread mortgage education to help more people obtain the goal of homeownership. This video is going to help because you're better going to understand what types of mortgage you might qualify for. The different mortgages that are available all have different requirements. So if you better understand your information, you better understand what debt to income is, and you have a better understanding or just a basic grasp of how to calculate your debt to income, which is not easy and it's not perfect, but you can have just a very, very general rule. Most people have this concept misunderstood and they're calculating the wrong things. Let's take control of your mortgage financing in today's video. You are probably ready to dive in, and today I'm going to cover 5 different things. I'm going to look at my cheat sheet because it's early in the morning and my brain's not functioning just yet. Number 1, what is debt to income ratio? Number 2, what is debt to income ratio in relation to a housing ratio? Number 3, how to calculate your debt to income ratio. Number 4, a quick overview of the different debt to incomes that they look for on the different loan types. And number 5, it is all case by case. So we're going to talk about compensating factors as well as general guidelines. So hang in there with me. We're covering 5. Let's dive in. Number 1, what is debt to income ratio? That is your debt in relation to your income on a monthly basis and also your minimum required payments. Minimum. You may have a credit card and that minimum payment's $25, but you might pay $150. We're going to use $25. So an example of your debt to income ratio would be, and I've got my handy calculator. Let's say that you have, and these are things that are reporting on your credit. So like if you pay rent right now, that's not going to go into your DTI. Let's say that you have $25 to a Target card minimum payment. Let's say that you have $35 to a JCPenney card minimum payment. Let's say that you have student loan payments. That's going to be a whole nother topic. A lot goes into this, but student loan payments, let's say the lender's going to use $300, and then let's say you have an auto loan of $425. So that is $785. If my calculator didn't just mess up because I pressed an extra button, but $785. That $785 a month is going to go into your income. So let's just say it's $785, even if I calculated wrong, it's okay. We'll keep moving. And your income is $4,000, that's a debt to income of 20%. So again, debts, meaning debts reporting on credit and minimum payments. Now, some things that don't report on credit is maybe you have an owner finance mortgage, or maybe you did some type of bond for deed, different things like that. But generally speaking, debts that are reporting on your credit, minimum payment required, not what you actually pay, but minimum payment required. And those numbers are taken in relation to your income. One thing I did leave off is if we're calculating your debt to income for the purpose of purchasing a home, your new house payment is going to go into that. So let's say if your new house payment is $1,000, we had $785. We have an income of $4,000. That's a 45% debt to income ratio. That was number 1. Moving on to number 2. Are you ready? Because I'm on to number 2. What is debt to income ratio in relation to a housing ratio? Remember our numbers, we had $785 plus a $1,000 house payment, proposed house payment, and a $4,000 in income. So we know what our debt ratio was because we just calculated that at 45%. What's the housing ratio? Well, you probably would have guessed it by now. We're not going to count those other debts. We're just going to count the proposed housing payment. That was $1,000. We had an income of $4,000. That's a 25% housing ratio. 25%. And that is your housing ratio in relation to your debt ratio. That was an easy one. Let's move on to number 3. All right, number 3, how to calculate your debt to income ratio. Well, I have mixed feelings about this because I'm showing you the calculations. We're going to go through another example. I'm going to get my pen, paper, and my calculator. We'll go through another example, but the problem is that most of you will not be able to figure out your debt to income ratio because if you're not using the right income calculation, then all of the numbers that you were crunching are completely irrelevant and very likely to be wrong. That is why it's so important that number 1, you are so transparent with your loan officer. Any and all income sources and whether or not they are stable, whether or not they are consistent, whether or not they're likely to continue, things like that. If you're self-employed, you have a lot of businesses, make sure you disclose all of that as well so they can calculate that income. Because if the income is not right, the ratio is not right. And here's a very interesting fact. You have the income that you put in your bank. You know how much money you get into your bank, okay? You make that much. That's real life. But then also you have income that's reported to the IRS that's taxable. So you might have income reported to the IRS, but then there's the taxable portion of that income. Those numbers, they are not exactly the same, right? Then you of course have income based on the employer. What I pay employees costs me a lot more than what they receive. So that's another version of pay. Of course, that's not the one the lender's going to use, but I still want to express that that's also something else to be considered and to just know knowledge is power, right? Or applied knowledge is power, someone recently told me. And the other thing is then you have qualifying income. So we have actual real life money in the bank, cash deposit. We have taxable income from the IRS. We're going to throw out the employer for this example. And then we also have qualifying income, and those items don't match. And for those of you who think you can look at your adjusted gross on your tax return and know that's your income, nope. I wish so much that it was that easy as a lender to calculate employment income. No. Not at all. As a lender, to accurately calculate your income, I don't even look at the adjusted gross. I calculate everything else. We look at every line item, every dollar, every explanation, what it goes into. There are things added back. There are things subtracted out. It is not easy. That's why you've got to trust your lender and get a really great lender. So let's go ahead and assume that you were able to calculate your income, or you have a lender and they've told you what your income is. So either way, we're now assuming that we have income. Let's say that our income is, let's go with, what am I feeling? How about $3,500 a month? Okay. We're going to calculate your debt to income. Let's say a $900 monthly payment. That's going to be our proposed house payment. Let's say that we have $75 to Target credit card. Maybe we have $40 to a Care credit card. What else do people have? Maybe they have $35 to Best Buy. What else do I see all the time? Oh, don't forget an auto payment. A lot of people have that. Let's say it's $325. And then let's say student loans, qualifying payment to be $100. That is $1,475. I'm going to divide that by my $3,500. That gives me a 42% debt to income ratio. Now, another important thing is that when you're calculating your debt to income ratio, you have to know what lenders are going to use. If you have loans, or whether revolving or installment, whatever, you have debt, shall I say, on your credit, and it does not report a monthly payment, there are different methods that the lender can use to, one, either assume that payment amount or to verify that. If that is missing, the lender cannot accurately calculate your debt to income, nor can you in that example. One other thing is when it comes to student loans, those payments are calculated based on the situation. Sometimes it's based on balance, sometimes it's based on actual, sometimes it's based on percentages, And each percentage is different for each loan type, and even conventional, which is one loan type. There's Fannie and there's Freddie, and their rules do not match. So there's also a difference on how they'll calculate your student loan payments. Get a good loan officer, because this is a lot for you to try to figure out on your own, but I at least want you to have the basic information. We are going to move on to our next one, which is number 4. Okay, so you may or may not know, but we have FHA loans, conventional loans, RD loans, and we have VA loans. Even with conventional, there's Fannie and there's Freddie, so sometimes there's variations. Well, there's definitely variations on their guidelines. But I want to give you just some reference points of the different loan types and what the debt to income ratios that they would love for you to have, but also what I've seen approved, even if you don't fit in that perfect box, which most of us don't fit in that perfect box. So let's see, we have FHA. They would love for you to have a housing ratio of 28% or less. Gosh, those get approved really great. They would love for you to have a debt to income ratio of 45% or less. That's very, very helpful as well. However, I have personally seen FHA approved debt to income ratios up to around 55% total debt, and I've seen them approve housing ratios in the low 40s. With conventional, they would absolutely love to see you have a housing ratio of 28% or less and an overall debt ratio of 45 or less. But again, like I mentioned earlier, Fannie and Freddie are different. I've actually seen overall debt ratios approve up to 49%, and I've also seen housing ratios approve in the low 40s as well. That was FHA, then we touched on conventional. Now we're going to move on to RD, or rule development. They, in my opinion, seem to have the tightest box to fit in. They want you to have a housing ratio of around 28%, but it is a big struggle that I have found. If your ratio for your housing exceeds 31, they just really, really don't want that. The overall debt to income ratio for RD, they really, really want you at 41% or less. It's very different than the other programs, 41% or less on that total debt ratio, and I've seen them approve around 43%. And last but not least, thank you so much to all my veterans, all of our veterans, for your service. VA loans, which are some of my favorite, because I just really believe that that's at the least that we can do for our veterans is give them a fantastic loan. With VA, they're not super picky on the housing ratio. They're really not. I think the highest I've seen them approve on a housing ratio is probably in the 40s. It's not coming perfectly to mind right now, but I think it's probably in the 40s. Sorry about that, just ignore that little ding there. And the overall debt ratio I have actually seen them approve as high as 65%. That seems really, really high. But VA takes a lot of other things into consideration with debt ratios than some of the other programs, and a VA loan has some of the lowest default ratios of all of the programs. So don't knock it too bad for allowing that high debt ratio. Obviously, they do know what they're doing. We are going to move on to number 5, which is last but not least. We're going to talk about compensating factors. With each and every program and the guidelines or the information I've given you today, as you can see, it is not a perfect box and an exact hard and fast rule. Guidelines are guidelines. They're not hard and fast rules. They're guidelines. They have some gray area in there, okay? And if you were ever teetering within the allowable range, let me explain. If you show up with a 70% debt ratio, forget it. They're not approving a 70% debt ratio. I don't care if you're putting down 70% on the property. It still has to make sense. So let's assume that you are in the range of what is acceptable, but you're pushing the envelope. Compensating factors will bring you sometimes from not approved to being approved. What are compensating factors? Let's dive into that now. Compensating factors, those are things like maybe you've been on your job for a long time. A long time is not a year or 2 years. That's good and that's stable, but many years, several years, right? 4 or 5, I would say, is my opinion. So you've been on your job for a long time. That's great stability. Maybe your housing ratio is really high, but your overall debt ratio is really low in comparison. And so sometimes that can be a comp factor. Another thing might be maybe you have a lot of savings or what we call reserves in the bank after closing. That means if you need $10,000 to close, but you've got $40,000 in retirement and $10,000 in your checking, well, you're gonna have $40,000 left after closing that you can pull for a rainy day. That would be another compensating factor. So we've got ratios, we've got reserves, we've got job time, we've got low debt in relation to the high housing ratio. I'm trying to think, what else am I forgetting? I feel like I'm forgetting something else. Oh, I thought of another one. Okay, what about payment shock? What that is payment shock is, let's say your rent is $1,400 and now your house note's gonna be $12. That's awesome if you've been paying $1,400 on time and we can verify that. That's a compensating factor. That's another example. I've created a guide for you. I'm gonna drop the link below. It's just a quick little chart that I've made that references the different loan types and the debt ratios and housing ratios that I have seen work to get loans approved. Type win in the comments below if you think that you can now better win at the mortgage game after having watched this video. Thank you so much for watching this video today. I'm gonna drop a couple of other links to some other videos that you may enjoy, and reach out. I would love to get a direct message from you, answering all your questions directly. I really enjoy the questions. I love hearing your success stories as well, so don't forget to share those. My Insta is _the_real_Stephanie_Weeks. I can't even say my own name. And then my Twitter, which I always have to cheat, is @lonelady_Steph. That's a mouthful.